Have you ever taken a moment to ponder over the sheer volume of dividends you could possibly rake in with a relatively modest investment of $100,000? Dividends, a term you may have come across if you've ever dabbled in the world of investments. It's quite popular amongst investors, especially those looking for a passive income generation strategy. But what exactly are these dividends? To put it simply, dividends are essentially payments made by corporations to their stakeholders. These stakeholders can range from large institutional investors to small individual shareholders. The purpose? Sharing a portion of the profits as a thank you for their faith and financial backing. The allure of dividends lies in their dual nature. They not only provide a steady stream of income, but also the potential for capital appreciation. This dual reward system makes them a favored strategy by many. But how much can you actually accrue? Well, the scale of dividends you can amass is contingent on a number of important factors. It isn't just about the amount you invest. The two most crucial elements are the dividend yield and the quantum of shares you hold. Let's clarify this with an example. The dividend yield is similar to an interest rate. It represents the annual return on your investment. To illustrate, assuming a 4% annual dividend yield, you stand to gain approximately $4,000 every year with an investment of $100,000. So, the next time you're considering an investment, why not ponder the potential of dividends? The potential to transform your hard-earned cash into a river of passive income. As we delve deeper into the concept of dividends, let's cite an instance of a high dividend yield stock. One such example is AT&T, the telecommunications titan with a rich history of consistent dividend payments. As per the most recent data, AT&T boasts a dividend yield of about 7%. Translating this into numbers, if you were to invest $100,000 in AT&T, you could anticipate an annual dividend income of approximately $7,000. This high dividend yield positions AT&T as a lucrative option for investors with a focus on income generation. Continuing our exploration of high dividend yield stocks, let's look at another compelling example. ExxonMobil. As one of the world's largest oil companies, ExxonMobil has a robust track record of paying dividends. As per recent data, ExxonMobil has a dividend yield of approximately 6%. To put this into perspective, if you were to invest $100,000 in ExxonMobil, you could expect an annual dividend income of roughly $6,000. ExxonMobil's consistent dividend payments make it a solid choice for investors seeking reliable income through dividends. Continuing our journey into the world of high dividend yield stocks, let's delve into another intriguing example. IBM. This multinational technology giant has been consistently paying dividends for over a century. According to recent data, IBM boasts a dividend yield of around 5%. To provide a bit of context, if you were to invest $100,000 in IBM, you could anticipate an annual dividend income of about $5,000. IBM's long-standing history of dividend payouts establishes it as a reliable choice for investors looking for consistent dividend income. Imagine a pie, a delicious fruit pie. The pie in its entirety represents a company's total earnings, the juicy, plump profits it has generated over a particular period. Now, the company could keep all of this pie to itself, but it decides to share it. This is where shareholders come in. Shareholders are like the guests at a party where this pie is served. They have invested in the company, provided it with the capital it needs to operate, to grow, and to bake that pie, or in other words, to earn profits. As the company cuts up the pie and distributes pieces to these guests or shareholders, each slice of the pie they receive, that's their dividend. The size of the slice or the amount of the dividend depends on several factors such as the number of shares they hold, the company's overall profitability, and its dividend policy. Now, dividends are not just a gesture of goodwill, they also serve a strategic purpose. They can be an effective tool to attract and retain investors, showcasing the company's financial health and its potential for future growth. The act of paying dividends is a declaration of success, a way for the company to communicate a positive message to its shareholders and potential investors. It's a signal that the company is performing well and has the ability to share the fruits of its success. So remember, dividends are parts of a company's earnings given to shareholders, symbolizing distributed profits. Now, when investing in dividend stocks, it's important to unlock investment success through diversification. This is not just a mere suggestion, but a tried and tested strategy that has been endorsed by countless successful investors over the years. The financial markets are a complex landscape teeming with opportunities and pitfalls in equal measure. Navigating this landscape requires a robust diversification that is the key that can unlock the door to consistent returns. When we talk about diversification, we are referring to the practice of spreading your investments across different classes of as dividend-paying stocks. The rationale behind this approach is simple. It helps by avoiding putting all your eggs in one basket, and thus you can safeguard against the volatility of the market. Now let's delve into how to choose these diverse investment options. It's important to target companies that carry low debt. Why is this significant? A company with low debt is generally able to weather financial downturns more successfully, thereby ensuring a more stable return on your investment. These companies are also more likely to have the necessary capital to invest in growth opportunities, which can further increase your returns. Moreover, gaining a competitive edge is crucial in the business world. Companies that possess unique advantages, be it superior technology, a strong brand, or unrivaled market access, are more likely to outperform their peers. These are the kinds of companies that you should be looking for. Finally, a great history of paying regular dividends is also an important factor to consider. Dividends can provide a steady income stream, even during market downturns. Therefore, companies with a consistent dividend payout history can offer a certain level of protection against the unpredictable nature of the market. Unlock investment success through diversification. Target low-debt companies with competitive edges and a great history of paying regular dividends. In conclusion, dividends truly offer a great value by providing stockholders a stream of passive income. It's important to understand just how this financial mechanism works and why it's so advantageous for long-term investors. You see, as we have already covered, a dividend is a sum of money paid regularly, often quarterly, by a company to its shareholders out of its profits. This payment is one of the ways you, as a stockholder, can reap the fruits of your investment without selling your shares. Now, when a company makes a profit, it has two primary options. It can plow these earnings back into the business to fund expansion or other growth opportunities, or it can distribute a portion of these profits back to its shareholders as dividends. The decision lies in the hands of the company management. However, companies that regularly pay dividends are often considered financially healthy, and thus attractive to investors. When you receive dividends, you can choose to spend them or reinvest them back into buying more shares of the company. The latter option gives rise to a beautiful concept called compounding, which can significantly boost your earnings over time. It's a win-win situation for you, allowing you to earn money on your money. Moreover, dividends also provide a sense of security during market downturns. Even in down markets, the dividend payment can help offset loss in the value of the stock. It's like a financial cushion that softens the blow of a volatile market. So yes, dividends do benefit stockholders with passive income, and they do so in ways more than one. And with all this insight, your perspective on investing in dividend-paying stocks might have just got a new light. Subscribe for more.